All right, everybody, welcome back to another video here on Financial Friends. Thank you so much for joining me today. Really quick, before we get this video started, I just want to ask if you could hit that like button down below. It's free, costs nothing, takes just a second. Thank you for doing that. I really appreciate it. And if you're not subscribed already, hit subscribe. Financial Friends is a community of people who love business, finance, and investing related content. I'm here to push that to you. That's what we're here to talk about today. We're on our road to 1,000 subscribers. If you could just hit that, it's free. It helps me get closer and closer to that goal and helps this friend group reach that goal. So thank you very much. Today, we're going to talk about the Federal Reserve, their interest rate increase, how that affects savings rates, how that affects the stock market, and why you should not be afraid of the words bear market and recession, but should instead see those as an opportunity. So, the Federal Reserve raised their interest rate today, 0.75%. What does this do? This helps to slow down the economy. It helps to keep this hamster wheel that we're on running very, very fast to slow. That's the goal of this, right? The Federal Reserve's job is really to keep the economy from overheating, and we've shown it's done that. Inflation is at 40-year highs. It is hitting highs all the time. We thought it was going to be going down. We saw a small decrease. It raised again. This causes concern for Americans because the prices of everything is going up. So instead, we incentivize saving. We incentivize not investing. We incentivize having to pay more on your loans by raising interest rates. When we raise an interest rate, it then becomes more expensive for any entity to borrow money. That means if you have a variable rate loan, it goes up. You have to pay more in your interest. Your credit card, the rate goes up. You have to pay more in interest, which means you don't have as much extra money, which means you can't invest as much money and help fuel the stock market. It also means you cannot purchase as many items. It also means businesses that would take loans cannot invest back in their business with that borrowed cash, not as much at least, because there is going to be a higher interest rate on that loan. There's going to be higher interest rates in your savings account, which will then incentivize you to save some more money. As we can see here, Ally keeps raising their interest rates. So the whole goal here is to keep things from overheating, keep the economy cool. Essentially, don't cause inflation. Reason why? If this isn't increased, it means you have more money in your pocket. If you have more money in your pocket, you're going to invest in stocks, you're going to buy more items. If you are buying more items, there is a massive demand for items because everybody else is buying those same items. And if the company can't make more of them, what are they going to do? Raise the price. What does that do? Causes inflation. What have we seen recently? Lots of inflation. So because of that, they have to do something, and they've done that. They've raised interest rates. In terms of the savings account, I really wanted to bring this up just because it directly shows this correlation that's happening. Federal Reserve raises interest rates. Your bank gives you more money back, aka incentivizing saving, putting more money on hand for them. And really, now you're just not going to spend as much money because you're a little bit more incentivized to keep it in the bank account rather than put it anywhere else. And at least you know you're getting roughly 1%, 0.9% in this case. But in some other cases, you can see that some of these banks have bumped up to 1.26%, 1.05%. I know SoFi is pretty much up there at that 1.25% as well. So again, keeping more money out of the economy, keeping you from spending more at merchants, which causes them to raise their prices. How does this affect the stock market? Well, people don't have excess money. They can't put it in the stock market. If they're afraid of the market going down because they know that businesses can't continue to fuel their operation and grow their business, people take money out of the stock market. That's what we've seen. A 21% dip in the S&P 500, a bear market. And I know that you've heard this term hundreds of times by now. I even made a TikTok about it. Go ahead, check out my social media down below. But I even made a TikTok about it. Bear market is a 20% drawback from all-time highs. We have seen that. Okay. We've also just got demolished over the past 6 months and over really the last month and over the last 5 days. Today, we did see some green. A quick explanation on that. A lot of times people expect something to happen. They expect the Federal Reserve to raise interest rates. They expected them to do it multiple months ago, and so they knew this was going to happen. They pulled money out. They were not invested during this period of time, but now that they know that this has happened, and we can be very sure, Federal Reserve said they're going to do X, Y, Z. They did X, Y, and Z. Well, now I'm going to put my money back in, and that's why we saw this green blip today. But what the last 6 months, year to date, the last year has shown us and given us is a purchasing opportunity, an acquiring opportunity, a building phase for your portfolio, if you will. A quick anecdote, I myself started investing, here is the last 5 years, I started investing right in here, the summer of June, July of 2020 during the pandemic. This shows right here what I've been able to do since then. I've been able to ride this wave up. But as I've become more inclined to invest, as I've become more educated and I understand more, I put more money in the market, which means I was purchasing at all-time highs nearly every single day that I was buying. Stock market just kept going up. So now that the market is dipping, it's providing me an opportunity to transport back to December of 2020 and buy at those same levels. It's given me an opportunity to lower my cost basis on my stocks, aka the average price that I've paid for any one of my positions, and that helps me ride the next bull market or ride this. This is the S&P 500 over time. You can see it pretty much looks like a straight line up. It's only when you get into these type of charts that you can eyeball these pullbacks. And as we move further in time, this pullback, or bear market rather, might look even smaller. Here's a history for you of all of the bear and bull markets and different recessions from 1926 to 2018. Now, shifting gears a little bit, talking about bull and bear markets and recessions, you can see they are not correlated whatsoever. Okay? Yes, a lot of them do line up, but here's a bear market, here's a bear market, here's a bear market, and here's a bear market. And you can see that there's no recession, a recession towards the end, a recession during most of it. And I think I picked this one, there's no recession, and this one again, there's a recession in the middle of it. But we've also seen recessions during this bull market, and the same bull market, and the same bull market again, and the beginning of that bull market, and during this bull market, and this one, and this one. So they don't have a correlation. A technical recession is 2 quarters, so 6 months, of a decline in GDP. That's all it means, right? Granted, things can get a lot worse. We can see 37% pullbacks in the stock market, or a bear market rather. However, they aren't always attached. Now, during these periods, when you see things falling, people selling their stocks, if you fall in line with them, you will sell at the worst time, aka, let's pick this one for example, right here. You will sell down here, and then when you decide that things are positive and good again, you're going to buy during this, okay? So a little bit of tough love here, don't do that. Instead, look at this as an opportunity. Extend your time horizon. Think beyond the next month, the next 2 months, the next 3 months, the next 4 months. Think 10 years out. If you'd have been thinking 10 years out right here, you'd be up here. Well, you'd be somewhere in here. With the opportunity to think another 10 years out, you'd be right here. So, use this dollar cost average into the market on the way down in something like this. And I'll reference back to current times here. Let's take a look at year to date. Buy in here. Buy right here. So that way you can be up here at some point. I know it's the same chart, but you get the picture here, right? You can build a position during a bear market, during times when things are crappy and you're supposed to not have your money in the stock market, right? If you have extra cash, anything you do have, and you have the ability, you've done the research, you've picked your positions, you understand what you're investing in, make investments that you understand and continue to purchase them and accumulate more shares of that position while it's down in price. The same old analogy goes, I have a video linked up here. If a t-shirt is on sale and you love the t-shirt and you would have bought it when it was 726%, 762% rather, in the green, why are you not buying it at 30% off? I don't know. You answer that for me. So with that being said, that has been this video. Push all this together in your brain. Go ahead and think about it for a little bit. Let me know what your plan is down below in the comments. I would love to hear it. Subscribe for more content like this. Hit like if you liked the video. I guess hit dislike if you didn't. And I will see you all in the next one. Take care.